Hello everyone, and thank you very much for joining our webinar. We'll wait a little bit for others to join as well before we start, but in the meantime, you can scan the QR code on screen to download the Oil Companies in Disguise report, which forms the basis for today's discussion. We can start, I think. So once again, thank you for joining and welcome to our Oil Companies in Disguise, our Investors Mispricing Automotive Climate Risk webinar, where we'll explore that several legacy automakers may be as carbon intensive as traditional oil and gas companies, and what are the implications for investors. My name is Marina Piligu, and I am engagement officer here at Carbon Tracker. For those who may not know us, Carbon Tracker is an independent financial think tank within the Tracker Group that delivers world-leading research to align global finance with climate goals, empowering investors, policymakers, and companies to make informed decisions. Our work is all free to access and download from our website, as well as the usual third-party investment platforms. Today's session will run for 45 minutes. We'll begin with a short presentation of key findings from the report, which you can again download from this QR code. We'll also cover key takeaways for investors, and we'll then move into a panel discussion where we will answer your own questions as well. To submit a question, please use the Q&A function. And please include your name so our team can follow up if needed. Presenting with us today is Ben Scott, author of the report and the head of energy demand at Carbon Tracker, who brings extensive experience in the automotive sector and financial analysis. Ben will also moderate the panel discussion, which will be joined by Ben Huriev, who leads InfluenceMap's global research on energy, mining, and transport, analyzing corporate advocacy on climate regulations. Nana Lee is also joining the panel. She is the head of sustainability and stewardship across Asia Pacific and IPAX Asset Management. She is the recipient of the 2025 ICGN Excellence in Stewardship Award and the author of Navigating Sustainability in Asia, a practical guide for corporate leaders and investors. And we also have with us Joseph Giacobelli, who is a managing partner at Board Impact Capital, a single family office, and founder of ACT-E, a non-for-profit climate finance and business insights platforms. Joseph has 35 years of banking and executive experience across Europe and Asia. He wrote 2 books on the energy transition and hosts the Asia Climate Finance podcast. So I'll hand over to Ben.
Thank you, Marina.
Presentation.
Thank you, Marina. Good to speak to you all today. Today we're going to be discussing a structural risk in automotive portfolios that is fundamentally ignored by mainstream carbon risk modeling. The core thesis for investors is quite simple. When you buy an automotive company, you're not buying a simple capital goods or technology play. You are, in fact, taking on a material long-term exposure to global oil demand and sovereign scale carbon liability. Over the next 10 to 15 minutes, I'll discuss the key findings of our report, Oil Companies in Disguise 2026, where we will break down the mechanics of what we call the carbon gap, show how current disclosure frameworks mask this exposure, and look at the divergence between electrification strategies that are creating structural winners and laggards. And afterwards, we'll open up the panel session. So please do put your questions into the Q&A box on your screen, and we'll try to answer those today. Next slide, please. Thank you. So let's align on the core problem here. Automakers are structural drivers of global fuel consumption, and there is a flawed narrative in the markets that passenger transport oil demand is an independent consumer choice. Our analysis shows it is a direct consequence of upstream design and capital allocation decisions. When an automaker builds and sells an internal combustion engine or hybrid vehicle, they are locking in 10 to 20 years of future oil demand with zero fuel substitution potential. And why does this matter so much? And as you can see on this first chart, road transport is the backbone of global oil demand, with passenger vehicles accounting for around 27% of total global oil consumption. While technological economics and policy targets anchor long-term electrification, near-term capital allocation shapes the velocity of oil demand destruction. If we can move the slide on one click, please. We project that a standard transition to 50% global battery electric vehicle sales share by 2035 will destroy as much as 14 million barrels of oil demand per day. And the structural risk for investors is that some automakers are actively slowing battery electric vehicle rollouts, preserving the legacy internal combustion engine and hybrid system, and artificially extending transition vulnerabilities. Next slide, please. And this brings us to our primary finding, the 33% median carbon gap. Across 17 global automakers, representing around 80% of global light vehicle sales, the delta between officially reported Scope 3 Category 11 emissions and our calculated real-world estimates is roughly one-third. And this is not a minor auditing nuance. It means that the standard risk assessments being used by institutional investors to evaluate transition readiness are structurally understating emissions. The distortion translates directly into mispriced transition liability and overvalued assets. Next slide, please. So how is this underreporting happening under existing compliance frameworks? And there are three main levers of methodological discretion. The first is lifetime mileage caps. Many automakers apply an arbitrary sort of flat rate cap on mileage, for example, 150 or 200,000 kilometers for their entire fleet. And this fails to account for actual road life expectancy and regional differences, and this drastically shortens the carbon emitting life of the vehicle on paper. Second, we have the plug-in hybrid myth. Testing cycles like WLTP assume extremely high electric-only usage factors, when real-world physical data shows that plug-in hybrids operate on their gasoline engines most of the time, emitting up to 5 times their laboratory ratings. And this is backed up by numerous other studies. And third, we have sort of boundary exclusions. Over 20% of emissions associated with driving are generated before the fuel ever hits the tank. So during extraction and refining. So excluding this well to tank boundary truncates the true emissions profile. Next slide, please. And the bubble chart shown here is a distribution of the 17 global automakers we analyzed using 2024 data, which is the latest data available for analysis. Just to explain the graph very quickly, the y-axis is the carbon gap, i.e. the delta between officially reported Scope 3 Category 11 emissions and our calculated real-world estimates. The x-axis is lifetime emissions per vehicle, and the size of the bubble is proportional to 2024 total annual emissions. And the first thing to say here is that no manufacturer performs very well in our analysis. Automakers should be aiming towards the bottom left of this graph. So this means a low carbon gap and low lifetime emissions per vehicle. And again, just to reiterate that across the industry, we're seeing underreporting of emissions by about 33% on average. I'm not going to talk about every single automaker here, but Toyota sits around the industry medium mark. But because of Toyota's scale, because it's the largest automaker in the world, its absolute carbon gap is quite substantial. And we'll talk more about Toyota and hybridization a bit later, but please move on to the next slide. So coming to the core thesis of this report, when we normalize these emissions using the tons of CO2 equivalent per $1 million of enterprise value, including cash metric, the sector's true transition risk profile is exposed. So as the chart shows that the median automaker's adjusted carbon intensity is 3.2, and this is higher than traditional oil majors like ExxonMobil at 1.4, BP at 1.9, and Chevron at 2.1. And that it also closely trails Shell at 4.0. A similar trend occurs when analyzed on a carbon to revenue basis. This completely upends standard sector classifications. Legacy automotive is not a safe low emissions asset class. It carries identical transition risk to traditional oil and gas. Next slide, please. And we are witnessing a profound divergence in automaker strategies. On one side, we have the transition leaders focusing capital on dedicated battery-first electric platforms. These firms, such as BYD and BMW to an extent as well, are structurally eliminating long-term oil exposure and lowering their life cycle carbon intensity. On the other side, legacy laggards are slowing battery electric vehicle rollouts and relying on hybrid technologies as an incremental hedge. And while this strategy avoids immediate capital write-downs, which we've seen recently, it tethers the company's valuation to terminal internal combustion engine architecture and leaves them highly exposed to tightening compliance mandates. Next slide, please. So let's dismantle the hybrid hedge narrative that's we often see used by some of the incumbent manufacturers. So adding a tiny battery to a standard gasoline engine does not represent a deep decarbonization path. As we show in the report, Toyota's 2024 hybrid fleet emissions alone exceed the combined emissions of entire automakers like BMW. Furthermore, there is a fundamental difference in hybrid architecture. Pure play battery electric vehicle developers like BYD construct hybrids around advanced electric first drivetrains, which achieve significantly higher operational efficiency. In contrast, legacy automakers often use ICE bolt-ons as an incremental hedge, leading to a higher carbon footprint per vehicle. And another interesting point here is that if ICE vehicles were excluded from its reporting, Toyota's hybrid segment would still rank as the seventh largest emitter globally. So staying with Toyota, is Toyota making progress to bring battery electric vehicles to market? While hybridization remains central to Toyota's strategy, the automaker has seen an increase in battery electric vehicle sales through 2025, and also year to date 2026, albeit from a low baseline. And it's worth noting that while the report we've written relies on 2024 data and is inherently backwards looking, Toyota's current challenge lies in transitioning from ambition to implementation. And given its history of downwardly revising battery electric vehicle sales targets, the company must now demonstrate it can deploy these vehicles at scale. However, Toyota's cautious approach has yielded some strategic advantages against a broader market backdrop of significant battery electric vehicle related write-downs by competitors like Honda and Stellantis. Toyota has successfully avoided these balance sheet shocks. Consequently, while Toyota is steadily progressing from a slow start, peers like Honda appear to be regressing from an equally sluggish baseline. Next slide, please. So finally, we must monitor the corporate accounting debate. So the Greenhouse Gas Protocol is the standard for carbon accounting across all industries and gives investors a comprehensive view of corporate climate risk across the entire value chain. By design, it requires automakers to report Scope 3 Category 11 emissions, i.e. the lifetime vehicle tailpipe use, ensuring that corporate design decisions and fossil fuel reliance remain visible to asset managers. However, there is a growing industry coalition called Carbon Measures. This is backed by oil majors and was actually recently joined by Toyota. And they're advocating for a transition from the Greenhouse Gas Protocol towards e-ledgers or e-liabilities. From an investor's perspective, this framework risks narrowing corporate accountability by shifting downstream vehicle emissions off the automaker's balance sheet, masking financial exposure to oil demand without changing real-world fuel consumption. Next slide, please. So this is my last slide before we move into the panel. For an investor, we believe there are six things that should be done to understand automaker transition. First of all, investors should assess the assumptions underpinning Scope 3 Category 11 disclosures. Reported emissions are only as robust as the inputs. Investors should demand transparency on lifetime mileage caps, the use of well-to-wheel versus tank-to-wheel boundaries, and whether real-world gap factors are applied to laboratory vehicle emission test cycles. Two, investors should prioritize verifiable battery electric vehicle sales share targets and delivery over long-term pledges. And this is the most transparent and comparable indicator of real transition progress. Third, investors should ask for, they should benchmark OEM reported emissions against standardized or third-party estimates to identify discrepancies that may signal hidden carbon liabilities, as we've analysed in the report we've written. Four, we should differentiate between OEMs investing in dedicated battery electric vehicle platforms and those extending internal combustion engine vehicle life cycles via hybrids. The latter risk technological obsolescence and stranded assets. Five, we should integrate tons of CO2 equivalent per $1 million of enterprise value, including cash or equivalent metrics, into financial analysis to capture transition risk more accurately and avoid mispricing high emission business models. And lastly, OEM engagement with alternative emissions reporting frameworks, e.g. e-ledger approaches, may signal attempts to reshape accountability rather than reduce real-world emissions. So that concludes my presentation for today. And if you would like to read the full report, please do go to our website or email me afterwards. I'd now like to invite our panelists to come forward, and we can start the discussion. And just as a reminder to the audience, if you want to put your questions in, please do input those into the box on your screen today. Brilliant. Okay, well, thank you to the panel for joining. As we wait for those questions to come in from the audience, maybe I'll ask a question first to Ben. Um, so my question here is, to what extent are the OEMs with the largest carbon gap in this report also the ones most actively lobbying against ambitious EV regulations?
Thanks, Ben. Well, firstly, I think there's a fairly clear correlation between lots of the OEMs referenced in this report with the largest carbon gap, particularly those in Japan and those with the most negative advocacy on EV regulations globally. One of the things that our research has repeatedly found has been there's a persistent link between companies with the weakest internal battery electric vehicle strategy and those with the most negative climate policy engagement on auto policies. And the opposite. So with companies the furthest ahead on battery electric vehicles tending to have the most positive engagement globally. And in particular, this is noticeable with the Japanese automotive sector and Toyota in general that have repeatedly lobbied against supply side regulations for electric vehicles globally over the last 3 or 4 years.
Thanks, Ben. So yeah, Japan and many of the Japanese automakers definitely laggards in this transition. So staying with you, Ben. So for investors trying to assess which automakers are genuinely sort of committed to the transition, how useful is lobbying and policy engagement data as a signal alongside the emissions data that we present in this report?
I think lobbying data is often one of the best proxies available for investors to understand how internally committed many companies are to the transition compared to sort of the public statements they might put out. So, for example, if a company is strongly committed to the transition, they'd be tend to support supply side regulations for the sector in lots of the key operate regions that they operate in. And it then suggests that their internal strategy on electric vehicles is genuinely ambitious. I think a great example of this is Volvo Cars, where their external advocacy in strong support of climate policies, such as the EU's 2035 100% CO2 target previously, shows a genuine commitment to the transition. And internally, they also have quite strong targets on their EV deployment over the next few years as well.
Thanks, Ben. And going back to what you mentioned earlier about Japan and Asia more broadly and the transition, I'd like to bring in Joseph into the conversation. So, Joseph, how do you see the regulatory landscape in Asia, and how do you see that kind of shaping up for automakers and the transition? And are investors kind of keeping track of this as well?
Um, I guess first off, the question is it's extremely complicated. The second part is that no investors are finding it difficult to keep up. I mean, you've got some markets which are moving at the pace of a Fiat 500, the 1960s version, and other markets are moving at a more like a Bugatti, Mistral, or Lamborghini kind of speed. So it's very difficult to kind of talk about Asia as one single market. But at the end of the day, one thing that is, I guess, slowly being recognized, and people like Nana, who's here on the panel today, has written a whole book about it. It's very difficult to navigate, but what is really happening is that change is occurring very, very, very rapidly, and some markets which we did not think would have a very speedy energy transition, such as Vietnam and the Philippines, have actually proven us wrong. They've actually accelerated. So there is that capacity here to accelerate quite rapidly. And one final point is that we need to remember that Asia, at the end of the day, represents roughly 50% of energy consumption, electricity consumption globally. So it is not just a relevant market, but it's really the market to look at in the world.
Thanks, Joseph, and maybe a nice segue to bring Nana into the conversation. So Nana, several Asia Pacific OEMs like Toyota exhibit carbon intensity levels comparable to oil and gas majors. So from your perspective, how does this change the way investors should think about automotive exposure in their portfolios?
Yeah, I think the report actually challenges a long-standing assumption made by many investors. So historically, we always think automotive companies are beneficiaries of the energy transition, while oil and gas companies are viewed as primary source of the transition risk. I think what this analysis suggests is that the reality may be more nuanced. So automotive companies are not all on the same transition pathway. Some manufacturers are rapidly increasing EV cell, redesigning their portfolio products, and reallocating their resources into speed up the electrification process. And others may continue to rely heavily on the internal technology, the old engines they had before, and also hybrid technologies. So I think as investors, we need to move beyond thinking about automotive as a single sector. Increasingly, the important distinction is not automotive versus oil and gas. In my view, it is more about transition leaders versus transition laggards in the auto sector. So as we discussed before, I think Toyota is often at the center of this discussion. And it's important to recognize that the company has actually made a significant contribution to the vehicle efficiency throughout their hybrid technology, and also has delivered a very strong financial performance. However, we as investors are increasingly asking whether the hybrid heavy strategy remains the most optimal long-way pathway in a world where many markets are now accelerating towards the full electrification goal. So for me, I think the key issue is not whether the hybrid have value. It's more whether they are serving as a bridge towards electrification or they're delaying the current transition path. So as a long-term investor, impacts is less interesting in today's emission number, but we are more interested in whether the management is actually allocating capital in a way that will remain competitive from 10 years from now. So this is particularly important in Asia, I think, because transition pathways differ significantly across markets, as Joseph just mentioned. So like Japan, China, India, Southeast Asia are all moving very different speeds. The challenge for many Asian automakers is that they are managing multiple transitions simultaneously. So I think my key point would be that there are multiple pathways, but not all of them would be successful for the automotive makers.
Thank you. And maybe staying with you, actually, you kind of half answered this question, which I'm about to give you. But we show in this report that there's a significant gap between what automakers are reporting for their emissions and what those real world emissions are. We calculated that as Carbon Tracker. From a stewardship perspective, how should investors respond when a company's disclosures don't kind of fully reflect the full picture?
Yeah, I think the first point is that investors should never confuse disclosure with understanding. So one of the interesting findings I found from the report is that not necessarily the size of the carbon gap itself, but actually the fact that even reasonable emission numbers can produce very different results depending on the consumption being used around the like vehicle lifetime, mileage, or real-world usage. So from a stewardship perspective, I think that means investors need to move beyond the headline numbers and start interrogating the underlying assumptions. So some questions to be asked, for example, the lifetime assumption being used, is the company using like tank to wheel or well to wheel methodologies, and how do these assumptions compare with their peers? I think importantly, I would not automatically interpret carbon gap as evidence of poor intent or greenwashing. I think many companies may be well compliant with the existing reporting standards. The question for investors is whether disclosure is decision useful. So a good strategy increasingly requires investors to challenge the assumptions and not simply verify a compliance procedure. So the second point, I think, is that investors should not look at emissions disclosure in isolation. The way we look at it is that emission numbers are always an output of the company's strategy. So why engage with for example, automakers, I often are more interested in questions like your CapEx development and how you make those CapEx decisions, how the management thinks about electrification, how is the board overseeing all these risks, including transition risks, and how are executive incentives align with the long-term transition pathways. So those governance questions, I think, often tells more about the future emissions than the current disclosure number. So I think for good stewardship is when investors move beyond the numbers, the reported numbers, and begin testing the assumptions behind it.
If I can just
go ahead, Joseph.
If I can just supplement, I mean, not only do I 300% agree with Nana, but what we look at, for example, we're a small investor, but when we get into a position, we do an incredible amount of work, probably too much work, over engineering. But one of the things that is really, really key, it's the company's strategies and then the capex behind those strategies, and also how realistic that capex is. And then the next thing we need to look at, particularly for the more global companies, say Volkswagen, for example, is to look at what, do they have different strategies in different countries? What has been the track record of those strategies in those countries? And I think, there are some companies which have completely missed the boat in terms of markets, and I won't mention specific names, but looking at the management strategies, how much disclosure there is on that, how much they are willing to say when they are interviewed, and the track record on those strategies, one of the really, really key things to assess the long-term risk in investing in those companies.
Thanks, Joseph, for adding that. And maybe a question kind of back to you is, we sometimes see manufacturers, they have ambitious goals for electric vehicle sales targets. But then more recently, we've seen those targets diluted. The ambition just isn't there anymore. How does that kind of factor into your sort of assessment of the company and whether they're going through a sort of successful transition to, a fully battery electric organization? Is that something that you sort of consider when you're thinking about these companies?
We're pretty brutal when we look at these companies in terms of the energy transition. I mean, of course, companies will have long-term plans, and then there's going to be, say, for example, 5-10 year plans, and then there's going to be some annual tweaking on those plans. But some of the companies have made very, very major turnarounds, pretty much against the original strategy. So for us as long-term investors, again, we're not talking about, I don't trade companies, so I can only talk about from a long-term investment perspective. I just avoid them because as far as I'm concerned, they haven't complied, quote unquote, with their original strategies, and they're very much deviating from what they originally wanted to do. And especially, there's increasing pressures, be it regulatory, be it from consumers. And we've seen it in Europe very, very recently with EV sales going through the roof. And all of a sudden, you've got these companies that 5 minutes ago had said, oh, maybe we won't get into electric as much as we originally thought. But all of a sudden they say, oh yeah, no, just kidding. We're going to get into bed with maybe some of the Chinese makers or whatever it is. So those are not the kind of policies or disclosures that make us confident, because there isn't really a long-term strategic, clear view of what they want to do and how they want to do it. Short-term market misreading is acceptable. I mean, things change, e.g. the Iran war, oil prices going through the roof. But a very sharp change, deviation from what they're originally going for is not something that us, at least long-term investors, would be looking at. I'm not sure if Nana would agree with that.
Yeah, definitely.
So yeah, definitely sort of strategic implementation is kind of very important for you when you're understanding these companies and whether they are kind of sticking to a plan to meet those electrification goals, but also considering that, of course, things change in the short term and you have
Right.
to be sort of agile to adjust to those changes.
No, absolutely. I mean, and things do change, but I mean, I think the general view, for example, is that oil prices are not going to keep on going up for the next 5 years, right? So there are you can get some kind of clarity out of this obscurity, if I can put it that way. So you've got to have kind of, you can have dual strategies, you can do all sorts of things, but completely pivoting away from what you're originally trying to do. And now they're regretting it because, EV charge, one of the biggest issues with EVs, of course, were the charging stations and this distance anxiety. And there's less and less of that. And the pricing from not just some Chinese makers, but also some European makers are making consumers very, very attracted to switch to EVs. So that's just kind of proof that tangible proof that you've got to be very, very, very careful about like you were saying, Ben, tweak your short-term strategy based on market changes, etc. But what about the long-term view?
Maybe I'll stick with you, Joseph. A question I had coming back to the kind of the core thesis of the report we wrote. You were saying that carbon intensity levels are similar to oil and gas majors for many of these automakers. From your experience across capital markets, are financial institutions pricing this risk appropriately, or are they even considering this risk at all?
No, I mean, in my experience, I haven't looked at this for like last 35 years. Probably not. I think there's a general view that you look at the auto sector from a short-term lens rather than a long-term lens, and that could have something to do with it. And I think, as kind of Nana hinted to before, there's an over-reliance on the emissions disclosed, which, by the way, are historical anyway. So it's not really what the situation is now, what the situation is going to be next year or the next. So yeah, the short answer to your question is no. I don't think that capital markets have fully appreciated that.
Thanks, Joseph. I wanted to bring Ben back into the conversation. So towards the end of my presentation, I talked about um, this kind of competing sort of carbon accounting standard, and I talked a little bit about carbon measures as well, which is an ExxonMobil-backed coalition advancing e-ledgers to eliminate double counting on emissions. And as I mentioned, Toyota have recently joined that group. So Ben, I'll ask you the question first, and then I'll go to the rest of the panel. Does this ledger transition, which Carbon Measures is putting forward, is that a step forward? Do you think in terms of sort of tracing emissions, or is it more of a defensive effort to shift use face liabilities off OEM balance sheets?
I think looking at the historical lobbying records of someone like Exxon, it certainly seems like a defensive effort to shift these use face liabilities off OEM balance sheets. And I think it certainly raises major questions for investors and regulators around the quality of emissions data going forward. So right now, Scope 3 certainly provides very valuable insight into the climate footprint associated with a company's core business decisions. So e-ledgers may have some value for calculating product level emissions for policies like carbon border adjustment mechanisms, for example. But replacing Scope 3 emissions would have major negative repercussions as these typically reflect, for example, the main and most direct consequence of a company's wider business model decisions. And it also ignores a company's responsibility to then reduce these Scope 3 emissions and prevent investors and regulators from fully understanding and questioning these emissions intensive business models. And again, it's important to address Carbon Measures members here. It's of note that Exxon is the largest investor-owned global CO2 emitter globally, and Toyota has most likely the largest Scope 3 emissions of any major automaker globally as of this year. And this accounting system really could be a strategy to shift this responsibility onto the person or consumers that burn these fossil fuels through, for example, owning a car, rather than the fossil fuel producers or automakers themselves. And I think that's a major risk. And it also risks challenging the GHG protocol, which is again used by the vast majority of Fortune 500 companies and other companies globally to calculate their own Scope 3 emissions.
Thanks, Ben. Nana, did you have a view on that? Obviously you're very familiar with the greenhouse gas protocol, and then we see the rise of organizations like Carbon Measures with I suppose a competing way of sort of measuring carbon emissions and accountability. Do you have any view on that?
Yeah, I think definitely we are using that, but as the report pointed out, and also as Ben just mentioned, it's actually not easy for outsiders to have an accurate estimate on the Scope 3 disclosure. And whatever number we are seeing today is probably underestimated from the automakers. So I think we look at that, but also we look more on some other maybe metrics. So well, the actual sales, for example, the combination of sales for the automakers in terms of EV to traditional petrol car or like a hybrid car, and also how the companies are making capital allocation decisions, how's the management making plans for the future development, investing in like EV platforms, batteries, infrastructure like charging infrastructure. And are they also extending the life of the legacy technologies? So and also we look at the pipeline for the products. So what percentage of future launches are EV, etc. And also the policy alignment. So whether investors nowadays, I think whether companies say publicly, and also how they engage with policymakers and the industrial associations, whether those are consistent, if they're saying something in support of EV transition publicly, but also lobbying against the policies behind the scenes, and that would be a very big, for us, that would be a big red flag. And also governance issues, as I mentioned just now. So how does the board oversee these risks, and also how do they gain the necessary expertise to make sure the board is qualified to actually make those strategic decisions, and how the executives are aligning their interest with the long-term development of the company. So those will be our key points, I think.
Yeah, a very good point on governance as well. Joseph, any thoughts there?
I 100% agree with what Ben and Nana mentioned. I guess the other thing to think about is that the supply chains of automakers are incredibly complex. So it's very, very, very difficult to get, and believe me, I tried and failed to get into the nitty-gritties of where each part comes from, and assessing the Scope 3 of some of these companies. So yeah, I think the complexities of the supply chains, which are global, a car I think has got thousands of parts, even EV cars. So it's very, very difficult to track, and I think that we ourselves pretty much look at some of the matrices that Nana mentioned as well.
Joseph, we're very quickly running out of time, so we're at 45 minutes, went very, very fast. So I'll end the panel session there. So just to say thank you so much to the panel for the interesting discussion today. I definitely learned a lot, but let me hand back to Marina to close us out.
Thank you, Ben. Thank you to all the panelists and to all of you for joining us today and for spending your time with us. As a next step, we'll be following up with some key takeaways from this session. We'll also share the recording and the presentation from this webinar, and we would be happy to discuss further the findings with you in more depth and explore how we can support you with this in the engagement part with these automakers. As always, you can find this report and our related research in our website. Thank you again for your time, and we look forward to continue the discussion beyond this session. Thank you and have a nice rest of the day.
Thank you.
Thanks so much.